So give us a nub of the story here. It's about hedge funds and the like.
Yes, exactly. I mean, the China reopening story is the world's most obvious macro trade right now. There's no debating that it's happening. It's not just COVID-0 being dismantled. It's all of Xi Jinping's pivots on property, on tech, on even geopolitical tension. So really, there's no controversy on how to invest in China right now in the short term, the tactical reversal trade. The kind of where it gets complicated is what happens next. What happens after this trade? What happens after the valuations kind of tick up to where they were and the kind of inflows that we're seeing now stop? And that's really the key question. And it's really, really hard to convince a lot of U.S. allocators, especially, to really get back into the China story. There's still...
They've been burnt, haven't they? That's the thing.
There's so much trauma, Rich, over the past 2 years. I mean, every time that people thought that China was rebounding, Xi Jinping then surprised investors with another policy that was damaging to private enterprise, to portfolios, essentially. So a lot of the capital that has left China over the past 2 years is not yet coming back. And you're seeing that in positioning data. Morgan Stanley has a really good data showing that actually US-based funds, when it comes to mandates on Asia ex-Japan, EM, and global, they're actually just as underweight China as they were in October when we saw the big pivot. So it will take a lot, really, to convince that capital to come back.
But they are coming back. I mean, what a start that we've had for this year. So who are the market participants driving this? Is it local? Is it... because we are seeing inflows, of course, already.
We are, and a lot of that is coming from the Asia-based mandates. And you're right. I mean, there is a lot of capital. When the MSCI China rises 50% since October, it's actually outperforming, amazingly, the S&P 500 on a 12-month basis now. So that's really hard to ignore, right? You're getting your clients asking, why aren't we invested in this story? You're also seeing, obviously, the short-term tactical players, that's your hedge funds, really getting into that trade, covering their short positions. Of course, let's not forget this was one of the world's most popular shorts trades for the past 2 years. So short covering flows from Asia-based fund managers, and also, obviously, the mandates that really have to be in China that follow China equities or, China fixed income as well.
But there are some out there suggesting that the mood music has changed in China, and they point naturally, of course, to what happened with that radical U-turn with COVID-0, and then some of the noises coming out with regards also to how capital should not be interfered with and the private sector should perhaps be left alone for the time being. But again, we don't know, do we? And the less usage of common prosperity as a term too. Yes,
exactly. I mean, there are so many reasons to be bullish right now. And I do think, Rich, if what happened over the past 2 years hadn't happened in terms of the trauma and the sheer distrust of Xi's policies and of government thinking, then you would really be seeing a much bigger rally right now. And it's all about the uncertainty of the past 2 years. But yes, I mean, everything is really pointing to a reversal on all the policies, not just one, not just COVID-0, but all the policies that have hurt Chinese markets over the past 2 years. It's the rectification of big tech is over. The suggestions from key policymakers, Gu Shuqing, who's really high up in the PBOC, very strong indicator there. The delisting threat may no longer exist. And also, the property market support is now also focused on liquidity risk for the developers. So it's not just mortgages and trying to get demand back up, but it's actually trying to rectify their access to capital. So a lot of positive stories feeding the narrative, but a lot of distrust as well.
Yes.